Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Just to tell us a little bit more about these moves, Larry, good to have you with us today. And as we mentioned, I suppose the weaker dollar really did see those futures rising in early morning trading, but it seems like more expectations of supply coming in on the crude inventory side of things from the US is now just, I guess, bringing things back to earth. Just tell us a little bit more about, the moves that you've been watching in oil this session.
Yeah, sure. Like, oil's been in a very contained range today. It's been volatile. It's been narrow. Obviously, U.S. dollar has something to do with it. Also, as you mentioned, EIA report comes out and people are just on the sidelines waiting for that. But beyond that, people realize that we're in a very highly correlated environment when it comes to commodities, when it comes to the U.S. dollar. So unless that report comes off one way or the other, I really don't think it's going to have a big impact on the near-term price, because right now it's more on inflation, on growth, on trade wars, on central bank tightening, and a lot less on the fundamentals.
Larry, crude seems to have held above $60 a barrel over the last 2 weeks on a closing basis there. Before we ignite any sort of further rally from here, it does seem like we need to see more evidence that the market is rebalancing, or that the rebalance does continue. Is that your view? Before we sort of see another rally, that's what we need to see. And are you confident in a rebalance this year?
Well, I don't think rebalancing necessarily means that we're going to be off to the races on the upside. It doesn't have to mean that. But, I just think the bullishness, at least we're up 3.5% on the year in U.S. dollar terms, and the bullishness really has come from all directions. You have OPEC incentives. You have global GDP of near 4%. You have some demand of like 2 million barrels a day, et cetera, et cetera. Can that continue to repeat itself? And I just don't think so. And that's why I continue to have more of a bearish outlook on crude oil going forward. I still believe it's going to be lower than it is today by the end of the year, because I don't think we can sustain that demand. The fact that the U.S. is supplying 1.6 million barrels a day. We have the non-OPEC response to higher prices, and also net length, speculative length in the market. It never ends well. So I'm constructively cautious right here, but fully realizing commodity prices in general are very highly correlated right now.
Yeah, look, we continue to talk about that ongoing theme with OPEC on the one hand, but those US shale producers on the other hand. We also mentioned in the lead up to you about the dinner that the OPEC officials and those US shale producers had, and they were obviously comparing notes there after a pretty difficult period of those low oil prices. I suppose they were hoping to stress once again the shared responsibility of, trying to get the market back in balance. But it seems like, the two sides not really growing fonder of each other at this point.
No, I don't think so. I mean, and I also point out things like gasoline prices in most emerging markets are back to 2013 levels. I look at things like diesel demand. It's just not. It's plateauing at a high rate. So I don't think we're going to see a huge correction right away. It's one of those things that I just don't think. The bullishness came from so many different directions, and I just don't think it can sustain itself into 2018. Mm-hmm.
Let's talk a little bit more about the broader market then today. Still trading relatively flat, and it does seem like there's some opposition coming out of Washington and the White House now with respect to Donald Trump's trade tariffs. It still seems like it's an issue, though, for investors, not just trying to work out from a US standpoint, but obviously it's about the rest of the world's response as well. Is that really, again, the focus of the market? Is that why we're seeing the market moving, all based on these these trade tariffs?
Yeah, you hit the nail on the head. I mean, just think of what, the end of February, everything seemed to go wrong. We had a little bit more inflation than expected, a little bit less growth than expected, more hawkishness, and then another trade war with a third trade deal that was mentioned in the last presidency. So, yeah, the market's cautious. The dollar goes down. It continues to go down. I think that will happen. I mean, the fact that we're putting in political risk with economic risk being end of cycle, I think that's going to continue to be a tailwind for the U.S. dollar going down. I still see about a 10% down move in the dollar, at least on a trade-weighted basis against the dollar index. So that's definitely affecting trends. It's affecting the correlation of the equity market as well. I mean, talking about sectors really doesn't matter right now because everybody is still, in shock of all those things that came together in the month of February.
Relative to fixed income, how do you find equity valuations at the moment? Obviously, certainly towards the end of the week, the conversation will once again turn back towards interest rates in the US Fed with the non-farm payrolls report. And look, we're continuing to see the rise there for those yields.
Yep.
Obviously, the bond market's still a big focus right now, but relative to fixed income in the bond market, how do you find equity valuations?
Yeah, no, I still think equities on a relative basis are at a steep discount compared to government bonds. And, you figure in the U.S. we still have negative real rates. So it's hard to make a case that rates going a little bit higher are going to affect the stock market. In fact, I think there's a positive correlation as long as they're going up for the right reasons. So that said, people tend to be overemphasizing, our interest rate, also our yield curve, and not looking at growth. People say, well, growth has fallen off the map. That's not true either. I mean, some growth numbers have actually done well. Wages, ISM, et cetera. And I think we're just plateauing at a higher rate. But that said, interest rates going higher, I don't see them going much higher than 3.25, just giving all the various scenarios going on in the world right now.
Larry, I know with the prospect of higher interest rates, we've spoken to you many times about it before as well, being leveraged to the banks and, say, the insurance sectors to take advantage, I guess, of the move in higher interest rates. When we look at financials and the insurance stocks, do they look attractive at current prices? Yeah,
I still think they do, and I still emphasize my overweight in the Eurozone, especially in banks and insurance companies, because I do believe, rates will slowly be going higher. They're not going to be going lower at this point, so I think that's only a net benefit to banks and insurance companies, and also relative to the rest of the market, or most of the market, their valuations are attractive. So I would re-emphasize that, and from the U.S. investor, I'm doing that on an unhedged basis, so I'm not hedging the currency risk.